Welcome to another lecture in the series. Greetings of the day. Now we are almost at the edge of finishing Unit 2. The next part that we are about to study is cash flow analysis, another important tool to perform financial analysis. So let's begin with cash flow analysis. Here, first of all, let us study the meaning of the term funds. Funds, basically it refers to, for the purpose of funds flow, basically, it refers to the term as net working capital, also known as net current assets. It can be defined as the difference between the current assets and current liabilities. So funds equals to current assets minus current liabilities, or you can say it is the net working capital. Then next comes the meaning of this term. You know that to check out the financial position, a statement is being prepared and it is made out in two ways. First is your working capital basis that we call as your funds flow statement. Then we have cash basis, that is cash flow statement. Here we basically are supposed to study cash flow statement. It is a statement of changes in cash position between the beginning and the end of the period. It is basically a statement which summarizes the sources of cash from which cash payments are made during a particular time, maybe a month or a year. In other words, you can say a cash flow statement shows the various sources of cash inflow and uses of cash outflow during a period, so thus it explains the changes in the position of cash in the business. A cash flow statement is not very much different from a funds flow statement. In fact, the main difference between the funds flow statement and cash flow statement relates to the meaning and concept of the term fund only. The term fund used in funds flow statement means net working capital. We have just discussed this on the previous slide. The difference between current assets and current liabilities. But in case of cash flow statement, the term cash means cash fund, and this cash fund has been defined by accounting standard 3. We will see to that. At this point, we should first distinguish between funds flow statement and cash flow statement, and then we will move towards the other definitions and concepts of cash flow analysis. Because if you see, funds flow statement is not a part of your syllabus now anymore because of its importance. So let us begin with the difference between funds flow statement and cash flow statement. You will see the cash position and working capital position. One of the statements is basically showing you the difference, the position of cash in the organization, that at one particular point of time, what is the position of cash? Because it is mainly concerned with the changes in cash position, whereas the funds flow statement is concerned with the changes in working capital. So it should be understood that working capital is a wide term and it includes the cash also. Okay, besides other current assets. So thus cash is only one of the constituents of the working capital. Then we have usefulness in short-term financial analysis. You know, for short-term financial analysis, cash flow statement is considered to be more useful as compared to funds flow statement. Why? Because it is useful to the management as compared to the funds flow statement, in the context that it helps a company to check out whether they will be able to meet the obligations within 1 month or not. For example, cash flow analysis will prove more realistic than funds flow analysis. Then method of preparation. Basically, the technique of preparing cash flow statement and funds flow statement are different. In funds flow statement, an increase in current liability or decrease in current asset result in decrease in net working capital and vice versa. But a cash flow statement, an increase in the current liability or decrease in current asset other than cash might result in increase in cash and vice versa. Then we have schedule of changes in working capital. A funds flow statement is generally followed by a schedule of changes in working capital. But a cash flow statement is not followed by any such statement. If I talk about opening and closing balances, in cash flow statement, opening and closing balances of cash and cash equivalents are given, whereas a funds flow statement does not contain any such balances. Then the legal requirements. There is no legal requirement to prepare the funds flow statement, whereas a cash flow statement needs to be prepared by every listed company as per the accounting standard 3, as required by your SEBI, that is Securities Exchange Board of India. Then further, let us have a look. The Institute of Chartered Accountants of India, ICAI, has issued Accounting Standard 3, which talks about cash flow statement in March 1997. Prior to this, there was Accounting Standard 3 only, but the name was changes in financial position. So this new standard, Accounting Standard 3, has superseded uh, the old one, which was issued in June 1981. So it is in tune with international trends, because cash flow statements have replaced statement of changes in financial position in almost every country. This accounting standard 3 has become mandatory with effect from 1st of April 2001, specifically for the enterprises whose equity or debt securities are listed or going to be listed on a recognized stock exchange in India. All other commercial, industrial, and business reporting enterprises whose turnover for the accounting period exceeds rupees 50 crores. The companies in respect of which Accounting Standard 3 is mandatory are required to comply with Accounting Standard 3 under Section 211 of the Companies Act 1956. This basically means that statutory auditors of such companies are required to give an assertion in respect of companies with Accounting Standard 3. And SEBI, that I talked about, it requires all the listed companies should submit a cash flow statement along with other financial results of the company prepared as per Accounting Standard 3. Now let us see the meaning of cash fund. As we have just discussed, Accounting Standard 3 defines all these things. So there are three contents of the term cash fund. First is cash in hand, second the demand deposits with the banks, and the third is the cash equivalents. These are the short-term, highly liquid investments that are readily convertible into known amounts of cash and which are subject to an insignificant risk of changes in value. Then meaning of cash inflow and outflow. Cash flow means inflow and outflow of cash basically. An inflow means that there is a source of cash which is increasing the total cash available at the disposal of the firm, while an outflow shows use of cash which decreases it. The difference between the inflow and outflow is known as the net cash flow, which can either be positive or negative, means it can either be a positive inflow or a negative outflow. Here you need to note that cash flow statement basically deals with the flow of cash fund, and it does not consider the movement into cash, bank balance, or cash equivalents. So this is in line with funds flow statement, which excludes the movement between the funds that constitute working capital. That is basically your current assets and current liabilities. Now let us have a look to the classification of cash flows. Accounting Standard 3 requires that cash flow statement should report cash flow during the period, which is classified into three categories, three activities, that is operating, investing, and financing activities. Operating activities are the principal revenue activities of the enterprise. Cash flows from these activities result from transactions and other events that enter into the determination of net profit or loss. For this, I have quoted certain examples here. Cash flows, we can have cash sales, cash received from debtors, or from royalty, fee, commission, and in case of finance companies, it is a bit different. Cash received from sale of securities, interest, and dividend receipts are also considered as cash inflows because they deal in that business only. Then cash outflows, we can have cash purchase and payment to creditors, payment of wages, salaries, rent, insurance, payment of taxes, and in case of finance companies, cash payment of interest and purchase of securities are there. We can show this all system of operating activities using this flow chart. These two sources are giving inflows, and these two further, these are the examples quoted here. Then next we have the second category of investing activities. These are basically the activities related to your long-term assets, basically your fixed assets. These are the acquisitions and disposal of your long-term assets such as plant, machinery, furniture, land and building, etc. and other investments which are not included in cash equivalents. Okay, let us have a look to that through the flow chart as well. What all we can have in this? See, we can have cash inflow using sale of fixed assets and shares, or it can be through the receipts from dividends, interests, etc. And for outflows, we do have purchase of fixed assets and purchase of shares, etc. for investment. Third category, that is financing activities. These are the basic activities that result in changes in size and composition of the owner's capital, borrowings of the enterprise. Here we have certain examples. We can see that there are inflows through issue of debentures and shares, or we can have inflow through the loans which we raise. And in the same case, we do have cash outflows by buyback of shares or debentures, or payment of your dividends or interest, or repayment of your loans. These are just few examples. Now let us see the treatment of other items like dividend and interest. In case of a financing enterprise, cash flows from interest paid and interest and dividend received should be treated as a cash flow from operating activities, whereas dividends paid should be classified as a cash flow from financing activities. And in case of other enterprises, the cash flows arising from interest and dividend should be paid should be classified as cash flows from financing activities, whereas interest and dividend received should be classified as cash flow from investing activities. Here we begin with net profit, which is adjusted for non-operating expenses and incomes. So what we do, we start with net profit, we add all the non-operating expenses, and we subtract all the non-operating incomes from it, and finally obtain the net operating profit from it. Let us see few more examples in this, few more categories. Next is income tax. Cash flowing arising from income tax should be classified as flows from operating activities unless they can be specifically identified with financing and investing activities. Like, for example, capital gain tax on sale of land can be identified with investing activities, and therefore in cash flow statement they can be shown as an outflow from investing activities. Then we can have certain extraordinary items as well. The cash flows associated with extraordinary items should be classified as arising from operating, investing, and financing activities as appropriate and separately disclosed. For example, legal claims or cost of winning a lawsuit or lottery, receipt of claim from an insurance company, etc. These are certain extraordinary items that we can have, because these are not in general a routine. They are like that they appear one or the other time only, means it is not a routine activity. Okay. Then non-cash transactions, these are the certain transactions which do not involve any cash inflow and outflow, although they do affect the capital and assets of enterprise, so they are excluded from your cash flow statement for obvious reasons. Let us have a look to certain examples like acquisition of assets by issue of shares or debentures, conversion of convertible debentures into shares, acquisition of fixed asset like machinery on credit. So these all are non-cash transactions. So hereby I have introduced the concept of cash flow statements today. So you must prepare the base first for the cash flow statement. Slowly in the next video I will be introducing the performer, though there are none introduced by any accounting authorities, but as per the approval of SEBI, we do have certain formats to follow. We do had older formats, but now we do not follow that. We follow certain new formats as per accounting standard 3 and approved by SEBI, so we use that for the calculation of cash flow. So we will be continuing with cash flow analysis in the next lecture. If you have any queries till now, you can write to me. Rest we will meet in the next video lecture now. Take care. Bye bye.